It is Tuesday. What is the date today? Tuesday, the 16th of November. Where has this year gone and where has the time gone? And so privileged and such an honor for me to be your host again. My name is Darren August. For those of you who may not know me, I'm Darren and I am your host on the ASISA Foundation's Build Up program, financial literacy program for artists. This program has been specially curated for you and with you in mind to really help you in your financial life and your financial future. And so thank you once again to the ASISA Foundation for bringing this program to all of our artists on the webinar today. Webinar 2, last week we kicked off with an amazing session. And we had our masterclass on Thursday, and today we're into webinar 2, and we are talking saving and investing. Just a reminder that weekly we will have a webinar on a Tuesday, and then we have a masterclass on a Thursday, all right? And so the webinar is a little bit more in-depth. The masterclass, we bring in an expert, and they literally run the show and talk through all of the content. So please do your best to attend the webinars on a Tuesday and the masterclass on a Thursday. It can only benefit you. All right, each week there are prizes for 2 participants who are engaged and who stay to the end of the webinar program. And so please make sure that you join us and stay until the very end, because there are some prizes up for grabs. And then I've already mentioned there is a dedicated Facebook group, a private Facebook group called Build Up for Artists. So please join that private Facebook group. And then there is a dedicated website as well, www.buildup.org.za, where you'll be able to find all of the information we share on these webinars, plus tons more. And of course, you get to watch the webinar replays as well. So you can go back, watch the ones that you've missed, or watch the ones just to recap on some of the information, because a lot of times we're not able to absorb everything in just this time that we have together. And so the site and the Facebook group is designed to really continue the experience even after the webinars. All right, saving and investing is what we're talking today. That's where we are, just a roadmap of where we're going as well. We're on our 3rd session together, but the 2nd webinar, we're talking saving and investing. And then this Thursday, we have our masterclass talking about building your brand, which is going to be absolutely amazing. And then we've got 2 more weeks together after that. And so by December, we're all going to be so empowered, so full of knowledge, and we are going to be on our way to a much better financial year in 2022. Let's get into it. And again, I'm not alone. I have some amazing guests who will be joining me on the webinar today. And of course, we've got our entire team in the background, Crystal running the chat. So if you have any issues throughout the webinar, please comment in the chat. Crystal will assist you. But let me quickly bring on our 2 guests just to say hello and greet everybody. So we have Sibongile Nojila, who is an actress, and I'll talk about her a little bit later on. And we have Palesa Dube, who is our certified financial planner. So Mam Sibongile, if you could switch your camera and microphone on and just greet everybody on the webinar today. And also Palesa, if you would do the same. Okay, Palesa's on. Palesa, you can go first.
Morning, everyone. It's wonderful to be here. I'm looking forward to an informative session, and hopefully it will be as valuable to you. Thank you for the invitation.
Awesome stuff. It's great to have you, and we're going to chat to you shortly, Palesa. Thank you so much for being with us. Mam Sibongile, are you ready to switch your camera and microphone on and just say hello quickly?
Good morning. My name is Sibongile Nojila. I'm happy to be here.
Great stuff. So good to have you with us. We normally only see you on TV, and here you are on our webinar screens on our devices today. We're going to chat to Mam Sibongile a little bit later on. Thank you so much for being with us. So as I mentioned, today we're talking saving and investing. This is webinar 2 of the Build Up program, financial literacy program for artists. And so when it comes to saving and investing, remember last week we spoke about budgeting, and a big part of the conversation centered around the fact that we even need to budget for savings, and we need to include savings in our budget. And so we're continuing the discussion today, and we're talking a little bit about saving and investing. And obviously, I know when it comes to these topics, we have so many questions. How do we start? Where do we start? Where do we invest? How do we save? And so that's what today's webinar is designed to answer. And so when it comes to saving and investing, the first thing to remember or to consider is that saving is the act of delaying immediate spending until you accumulate enough money to spend on something worthwhile in the future. All right. Saving is money that you set aside for things you need to pay for in the future. All right. And then investment is a little bit more when you think about longer periods of time. All right. And so that enables you to start building and creating wealth. You should have savings for short-term goals, and then you should invest for medium to long-term goals. So that's the main difference. So when you think savings, you think short-term, investments, you think medium to long-term. Those are the key some of the key differences. All right, so then obviously the question arises, so which one is more important? Which one should I start with? And the answer, guys, is you need both. All right, you need to save and you need to invest. And so you could probably start saving within a bank account. That's normally good, like a money market. For short-term goals, like saving to buy a new fridge, or at the end of the year you want to go on holiday. That's how you would probably then save. All right, then medium goals include saving for something like a car, or maybe a deposit on a house, and so you want to start investing in a couple of different tools to start building wealth, all right, and saving for the long term. And so you want to consider things like unit trusts or endowment policies or tax-free savings account. Those are ideal for medium to long-term goals. And then long-term goals like saving for retirement or tertiary education for your children, those need investments, and those need to be thought about on the long term, all right? And so those are some of the keys, but very important. Don't only think I need to save or I need to invest. You actually need to be thinking and considering both. When it comes to investing, investing is to buy financial assets and put money in financial instruments for a specific time period in order to make your money grow and in order for you to grow your wealth, all right? So that is the purpose of investing. And so in order to invest, you need to think about making more money than you originally invested. That's what it is. It's about earning profit, all right? And so you need to be willing to leave your money invested for a reasonable period in order for it to grow. And the recommended time frame is around 5 to 10 years or more. And then obviously financial instruments for investing are assets include things like shares, property, bonds, and cash. And we're going to be talking about that a little bit more in depth in a moment, and especially when I bring on our financial planner. So what are shares? Shares are also called equity or stocks. And when you buy shares, you are literally buying part of a company, all right? And you're buying a portion of ownership in a company. And so companies will issue shares to raise money to grow their businesses, which are then bought and sold by investors on the stock exchange, such as the JSE, all right? The Johannesburg Stock Exchange. And so if you buy shares, in essence, what you do is you are sharing in the company's profits and losses, all right? And so what are bonds? Bonds is a financial tool that is used by governments or municipalities to borrow money from investors, all right? And so you basically are borrowing money to the government or to a state-owned enterprise. And so when investors buy a bond, they in essence are giving a loan to the organization, who then will repay the loan with interest, all right? And also a great way for you to start investing and for you to start generating and creating that wealth. And I do know that Palesa is going to touch on that a little bit more as well. Then another way of possibly investing is property or real estate. And so you can invest in property either by purchasing a property and then letting it out. And so you now become a landlord and have tenants, or you can invest in a property fund, all right? A real estate investment trust or a property fund. Those are ways of how you can invest in property. And again, that's a completely different ball game, but it's a great way as well of starting to generate wealth. Cash. We know that investing in cash could mean investing in high interest accounts, such as fixed deposits or money market accounts. But with cash is usually lower risk and lower return. And so you don't expect to make huge amounts of interest if you are just saving or investing in cash, all right? It may not be suitable for long-term investing, but it is a bit more suitable for short-term investing. And so do consider that as well. Then very important is for you to diversify, all right? So I'm sure you would have heard the saying that says, don't put all of your eggs in one basket. And it's so important. It applies so much when it comes to saving and investing as well. And so one way to start diversifying and investing in the various asset classes is through unit trusts. And I do know that Palesa is going to talk about this quite a lot more as well. But a unit trust in essence is an investment that gives you easy, affordable access to financial markets like the JSE and bond market, with the potential to grow your savings. And so when you invest in a unit trust, what you're doing is you are pooling your money with a group of other people. And so instead of you now being able to invest a lump sum, you're purchasing a unit trust, which is a smaller portion. And so it's almost like another word for it is a collective investment scheme, where a couple of people are putting in smaller amounts of money, but that makes up the ability to invest in certain products or certain companies or certain funds. All right, and unit trust funds may also diversify because you're able to invest locally and you're able to invest offshore. All right, and so again, this is the kind of things you want to be discussing with your financial planner. And so today we're really wanting to give you an introduction into all of it so that you start asking the right questions, learning a little bit more about it, and then decide what your plan of action will be. And again, you can only develop that plan with a certified financial planner who's actually licensed to give you financial advice. And so a couple of ways of how your investment grows in a unit trust is capital gains, dividends, and interest. And I'm not going to touch on it because Palesa breaks it down really, really nicely when we get to her segment. And so, but I just want you to be aware of that. Those are a couple of ways how your investment grows when you are investing in unit trusts. Then another one is exchange traded funds, or known as ETFs. I said EFTs earlier, but it's ETFs, okay? And so here, you almost think of this as a basket of shares, all right, bonds or other securities. And so typically what happens is you're able to invest in a single share that represents a whole lot of others, all right? And again, it's a great way for you to diversify because you're not just investing in one particular product. And so Palesa is going to touch on that quite a bit more as well. So like a unit trust, you are pooling your money with that of other investors to invest in the same set of securities in the financial markets. And then, of course, when it comes to investing, it's so important for us to consider investing and saving for retirement, all right? And so when you get to retirement, the idea is that you want to be able to maintain the lifestyle that you lived before you retired, okay? And so, of course, remember that there are added health and medical costs that are required as you get older, simply because you're not young anymore. And so you want to be able to afford all of those costs as you get older. And so it's so important to start saving early for retirement, all right? Because that's how you're going to be able to benefit the best. Most financial planners encourage you to save 15% of your salary towards retirement. And apparently, if you start saving at 40, you need to start saving 33% of your salary. So you can already see that the earlier you start, the better. And so you may invest for retirement through retirement annuities or employer-based pension or provident funds. And I do know Palesa will touch on that as well. And then, guys, when it comes to saving and investing, there are so many scams. And so it's so important that we are mindful of that and that we are aware of it. And so how do you identify a scam? Firstly, if they promise you you're going to make a lot of money in a short space of time, it's possibly a scam, all right? If it seems too good to be true, it probably is. Okay, that's how you can remember it as well. Sometimes you need to get other people to invest. That's a great sign of a scam as well. There's no knowledge of where the money is invested. There's no transparency. They say, put in this money and you're going to get so much out. And you're like, how am I getting it? Where are you investing it? And there's never answers. There's never clear answers, all right? Often these promoters are not registered anywhere. They're not registered with the financial services boards and all of the regulatory bodies, and there's fake websites. Okay, so watch out for those because that's how you're able to identify scams. I know these days there are so many going around where you get emails and they say click on this link, and you click on a link and that's how they are able to access your accounts. And so watch all of those things. Be very careful when it comes to scams. Okay, let me stop talking and I'm going to bring on our first guest, who is Mam Sibongile Nojila. Let me quickly read her profile for you. Sibongile Nojila is a South African actress, voice artist, and puppeteer who has acted in numerous television series, including Soul Buddies, Kinako, Justice for All, Heartlines, Isidingo, Zero Tolerance, Josie H, Hillside, and Angel Song. She has also had guest starring roles in the SABC1 drama series Intersections and Skeem Sam. Sibongile trained at Mabane Cultural Center in Mafeking and later came to Johannesburg, obtaining a drama honors from Wits. In addition to acting, she also trains budding actors. Her biggest challenge in the journey as an artist was relocating from Mafeking to Johannesburg at the point where she was still making a name for herself and had lots of cost in terms of relocation. She believes that artists that don't get into saving and investing because of lack of knowledge, fear mainly from having an inconsistent income, but she believes that saving and investing is also key as a measure to prepare one for the uncertainties of the industry. Mam Sibongile, if you could put your camera and microphone on and join us on screen. What a privilege to have you on the webinar today.
Thank you.
Let's get straight into the discussion. And so tell us a little bit about your journey as an actress, sorry, and creative in the industry. What are some of the realities of working and earning a living in this industry?
Good morning. The reality of our journeys is that we love what we do. We do it with so much passion. But unfortunately, because of the nature of the industry, there is no stability and our work is seasonal. So we have to be very careful and very smart with our finances because not most of us don't have the luxury of earning money on a monthly basis.
Mm. So what was the challenge with your move to Johannesburg when you were starting out?
Whew. You are reminding me of that journey. I just decided to come to Johannesburg after a beautiful show at the Market Theatre. So I honestly believe that because everybody knew who Sibongile was based on the reviews of our show. So I thought, yo, it was going to be easy to come here and actually make it. And I was mistaken. I literally had to start from the bottom. They say you are just as good as your last job. I tasted that. When I came here, nobody remembered me, nobody knew me. I literally had to start afresh. So I remember that year in 1997, the only income that I made, I actually earned 370 something. It was the only income that I made. Fortunately, when I was based in Mafikeng, I was a person who has always believed in saving. So fortunately, when I moved here, all those savings, unfortunately, they ended up paying rent, paying my living costs, and everything. At some point, my family had to chip in and actually do the opposite. When I was supposed to be looking after them, they were actually spending money in Johannesburg.
So this industry we know is characterized by inconsistent income. You mentioned that your longest acting contract was about 12 months or a year. So with such realities, how does one save and invest as a person employed in the industry when you do not have a regular or a stable income?
I will start by saying, obviously, most of us we want to be in front of the camera. Most people, that is what they want, but there are other opportunities within the industry. If ever, for instance, the acting thing is not working out quickly, I think people must start considering other options. You can always go back. It's important to create that stability for yourself. Otherwise, you're going to wait forever like myself. And upcoming artists now, they are fortunate because all this information is out there. We had no one could advise me that way because my mentors were very protective. And even when I moved to Joburg, they never actually prepared me for the reality of the industry here. So it's important that if one thing is not working out, try to do something at that moment. The other alternative is because when we get work, we get most of us we get good money out of our project. So probably is the time to actually look at that season that, okay, this season I'm working, I can do A, B, C, D, but saving must be on top of the list.
So what motivated you to start saving? And in your experience, what has enabled you to be consistent with the savings and insurance policies and that sort of thing that you've committed to?
I actually started exploring other opportunities. I do translating work. I do this a side hustle on the side where I train upcoming actors. So I'm able to be creative, find ways of bringing that income because it's not even a lot of money. Sometimes you can even start saving 100 rand. Just make sure that you raise it. I honestly and truly believe that we actually don't maximize our potential. There is so much that we can do. As freelance artists, I don't know how many times I used to sit at home, not doing anything. And that's the thing that actually pushed me to go to school because I was like, okay, I spend most of the time, I can literally count the days that I work in a year. Why don't I take this time and invest it for myself and do something positive? That is why I was able to go to school and I actually studied full time.
Hmm. So having started some saving or investing, what do you see as the benefit of it?
Peace of mind. Peace of mind. And when you start, there's this thing that you want to do more. So start that journey, because then you're going to be encouraged actually to even work harder and to even maintain what you have started. When you want it, because half the time when people in my industry, they pass away, most of the times it's just a sorry state. People will be speaking things in the media, there's no money, there's nothing. Whilst in some instances, at my level, I took a burial scheme. It's for me. I don't want a dome. I don't need a dome, but I've prepared what I can afford for myself.
So when you say the biggest benefit for you is peace of mind, what do you mean? Tell us a bit more about what do you mean by peace of mind?
I mean, I know that I've managed to take care of the most important business, because if I'm living in this world, I only have one life. And I'll be lying to myself if I don't think of making the necessary plans, because tomorrow is not promised. I'll just be lying to myself. So most of the times, we as artists, we live under a lot of pressure we end up doing things that we are not even supposed to be doing, because sometimes we want to maintain this lifestyle that people are seeing. Start with the basic, concentrate on the basic, do what is most important. Because when I live, and I shared that I was actually encouraged by a security guard to go and do one of my investments. A security guard who was unemployed at that time. That lady stopped me. She was like, "Yo, Mama Kaya, you know what? I need some money because I'm worried about my investments. They'll be going to my account and then there'll not be any money." And then she borrowed some money. And then I was like, "What is that?" Then she started explaining to me. I was like, "Wow, this woman is a security guard, guys. What's wrong with you? What's wrong with you?" And then that actually pushed me. That pushed me to actually just be brave and go.
Wow, that's so beautiful. So what tips could you give to others who may not have started, or who may have the fear of who may see savings as impossible for self-employed individuals? What tips would you give, especially to people who are artists, people who have inconsistent income? What tips would you give them to start saving and investing?
Sorry, I wish I could have started when I was very young. So these young people, my advice is start now. When you are younger, you don't have to invest like myself. At my age, if somebody is 20 years old or 25 years old and I'm 50 plus, I'm going to be charged double for the same benefit. So it's better that they start investing now. It's actually cheaper because it's long term. They still have a lot of time ahead of them. And then the other thing, let's be creative. Let's be creative. Fortunately, there are artists who are actually encouraging me on a daily basis. There's a young woman who's doing uzalo. She's selling hot dogs. She's selling hot dogs. It's a side hustle. Yes, it's all over. It's on the internet. So we need to come up with such businesses, because those are the ones, in the absence of this acting work and voiceover and whatever, because it's seasonal. That's the reality. Not everybody is able to go to any soapy every morning. The industry can only take so much people.
Wow. Mam Sibongile, I think you've encouraged us so much to start. And I think the one thing that we're taking away from you is start. You know, if the security guard outside can start and have some form of investment, what's stopping the rest of us?
Yes.
Thank you so much for sharing with us. Don't go too far. At the end, I want you to please think about a tip for the week. And we're also going to probably have some questions and answers. And so we'll bring you back at the end of the discussion with Palesa to answer some questions.
Okay, thank you.
That's Mam Sibongile, sorry, no Gila. Thank you so much for being with us. Next up, we have got Palesa Dube. Let me get the name up here. All right, and so Palesa is the co-founder and wealth manager at Wealth Creed, a private wealth management firm passionate about helping individuals achieve their highest financial and legacy aspirations. She has more than 17 years of industry experience, having worked in the private wealth management and private banking sector, where she advises professionals, high net worth individuals and their families, as well as corporate clients. Palesa's expertise are in investment and retirement planning, estate and legacy planning, risk planning, as well as business succession planning. She holds a firm belief that sound financial planning and wealth management services should not be the preserve of a few, but rather, if made a mainstream practice and easily accessible to the broader base of society, that it is among the most important interventions that can drive an improvement in decreasing the wealth gap in South Africa. She holds a BCom investment management degree from the University of Johannesburg, as well as a postgraduate diploma in financial planning from the University of the Free State. She is a certified financial planner, as well as a member of the Financial Planning Institute of Southern Africa. Palesa, welcome. Please join us on screen.
Thanks, Darren.
So good to have you. What an impressive CV. I feel like we are in the presence of greatness.
Listen here, you're making me sound too good.
So good to have you on the webinar today. Let's get into it. I know that you're obviously a financial planner and a wealth creator, or wealth coach is what they call them these days. So as an artist or freelance worker or entrepreneur with inconsistent income, where I could get nothing much coming in one month and then big lump sums in another month, depending on bookings, what is the best way to save and invest?
Darren, I thought you did such a good job earlier, and Mams Bongile as well. You know, her story is so inspirational. I don't think I need to be here. We can close this thing down. But you're quite right. You know, I think the experience of artists or freelance workers is quite unique, and the financial planning around that also has to talk to, you know, their circumstances. You explained very nicely earlier around the difference of saving and investing, right? And I think it's very important that we land that point. So when we are talking about savings, usually, you know, we advise our clients to have an emergency fund of between 6 to 12 months, right? So like you said earlier, savings, essentially, your emergency fund should be your savings. It's money that you can call on when an emergency happens. What is an emergency? Somebody passes away in the family. A tire gets, you know, you burst a tire. A geyser goes off into those kind of things that can cause quite a dent in the pocket, you know, and they are outside of your monthly budget. So when we talk about savings, that's what one should have in mind. So there, you want to make sure that your money is safe, and that's why we recommend products like your call account at a bank, a money market account, for example, because those are stable, they are consistent, but still earn you a bit of interest over time. When we talk about investments, that's where we want to create wealth, okay? That's where you want to be building something meaningful over time. So you need to make sure that you have the time. It's not money that you're going to be dipping into when there's an emergency. So you need to be clear in your mind that this is long-term money. This is money that I'm putting away for the future. That's the first step. The second one is, what do you invest the money in, right? And we'll talk about that in a moment as well. So that's where, like, your unit trusts, your shares, your REITs, all of those, you know, start to come into play, because that's what's going to grow your money over time.
Okay, so a lot of people may want to start investing, but feel that they don't have money to save or invest. Where does one find this money to save or invest?
Yeah, I think, you know, for the mere fact that you've got a job or you've got an income, then one shouldn't make an excuse. You know, you can start. I read you know, quite a succinct quote. They said if financial freedom is your goal, you need to tame your ego. Okay, and I think that's what stands in the way sometimes, because we get too caught up about, you know, well, what do I look like? What clothes am I wearing? What car am I driving? What house do I live in? And I think particularly in the arts, because you've got a certain, your job is your image, right? How you appear, how you present yourself is your job, but it can also be a pitfall. So I think one needs to be true to yourself and be loyal to yourself first before you're loyal to the rest of us. So you need to make the decision to say, what is it that I want for myself? What is it that I want for my family? And once you are clear with that, then it'll become easier when that 100 Rand comes in. You know immediately that, okay, 50% of it is going to my investments and savings, 50% is going towards my living expenses and things like that. So like Mam Sibongile said, even 100 Rand start, as long as you've started and you know that you are doing the best that you can. Don't say, don't be anchored on 100,000 because on 100 Rand, because we've said 100 Rand and then you believe that, okay, I'm doing something. If you are earning much more and you can do much better, I think, be loyal to yourself and have the discipline to actually start with your savings plan.
Let's talk a little bit about debt. So when somebody has debt, what is the best way to do? Is you try and pay off the debt first and also put some money in savings, or rather focus on the debt first, get all of that out of the way, and then start saving and investing?
That can be quite a difficult one. I think there's a certain satisfaction that comes when you tap into your investments, or the statement comes and you can see, the graph going up and up. But I think it's important, I would distinguish between good debt and bad debt, okay? And I would encourage everyone on the call to get rid of the bad debt. So what is bad debt? Things like personal loans, things like credit cards. Why are they bad? Because usually the cost of that facility, the cost of that credit card is quite high. When I say a cost, it's the interest rate that you are being charged for that facility, okay? So personal loans, because they are unsecured, they are usually quick because they try to entice people to take out the loan. They tend to be expensive, okay? So that's what you need to look at. If you're going to be paying 15%, 20% for a facility, then any investment is going to have a very difficult time trying to keep up with the cost of that borrowing. So first, kill the bad debt. Then, there's other debt which I think one can carry, which is good, if I can call it that way. There, for example, like a bond, bonds are usually structured over 20, sometimes 25, sometimes 30 years these days. But at least there's an asset underlying the facility, and the asset, hopefully, if it's in a good area, grows over time. If you've taken out a loan, for example, for a business, at least that's something that's revenue generative, right? If the business is profitable, you're making that money work. So ultimately, I think once the bad debt is settled, one can then run what I like to refer to as a 3-bucket system. So in other words, you'll be taking care, paying off that long-term good debt, your bond, and things like that. But then also there should be an allocation to your investments. We've spoken about savings and investments. So there should be a second bucket should be going there. And then as well, also saving towards your emergencies. So when the bad debt is out of the picture, carry good debt. Even the good debt, I think one must be focused and try and settle it as quickly as possible. But that's the kind of debt that I would carry. So to answer your question, kill the bad debt first, settle that first, and then carry the better debt, but always be making sure that you're putting aside something towards your savings and investments.
Nice one. So Palesa, when it comes to emergency savings, what is the best strategy to get this in place? How much does one need to save for emergencies, and how does one get started?
So like I said earlier, we usually encourage our clients who earn a consistent income to have between 6 to 12 months worth of expenses in an emergency fund, right? So if COVID happens again, if you are sick for an extended period and you can't work, at least then you know that you can carry yourself for that period. But having said that, in the economic environment that we find ourselves in, and particularly to the audience that we're talking to today, who earn inconsistent incomes, I would say extend that emergency fund from 12 months to even longer. If you can have an emergency fund for about 2 years, I think that's great, because that really puts you on a firm footing. 2 years is a long time to find your next gig that's going to pay you well. At least then you know that your rent can be paid, debit orders, children's expenses and things like that. Those things that really niggle on one's mind and stress you out. You want to be sure that you can meet those obligations.
Let's move the discussion now to investing, right? So we know when it comes to investing, we obviously have goals in mind. And so there's short, medium, and long-term goals. What is the best way to start planning for investing now?
Everything starts with a plan, Darren. And I'd like to encourage everyone to really do not be shy to engage with a certified financial planner, to have yourself sorted out. I think sometimes people think that, oh, you know, I earn an inconsistent income. I don't earn much. I'm still new in the industry. I'm up and coming. Where am I going to find the money and all of that? The fact that you are thinking about those things and it's a concern to you, invest the time with a financial planner to really have a sort of like a broad roadmap for you, right? So if you know that, for example, I want to retire and be financially independent at the age of 50, what does that look like? What will it mean on a month-to-month basis? How much do you need to be putting aside? And sitting with a financial planner, you know, we can help with those kinds of calculations and also considerations. So now if you know that, okay, this is my goal, and in order to get there, I need to make sure that I'm putting away 100,000 a year. The next question is, well, where do I put that 100,000? Is it going into my bank account? Is it going into an investment? And if it's going into an investment, what kind of investment? So I'd really like to encourage everyone to invest the time, even if there isn't a lot to work with at the beginning. It's about your dreams, right? It's putting a picture on that white canvas. And it's also going to encourage you. So as you go about in your career, you have a clear picture of what it is that you need to be doing. How much does this project need to be paying me? And whatever I get out of it, how much am I going to put away? Because I'm clear what it is that I'm working towards. So consult with a financial planner, dream. When you do come to talk to us, we want to know, you know, what are your dreams? What are you working towards? Do you want to be living in Sandhurst? Do you want to take your children to the best schools in South Africa? That's what we work off, right? Money is just money. But the source of it, if I can call it that, it's about what it can give you, right? It's about the kind of lifestyle that it can provide for you. It's about the meaning that it can add to your life and the people around you. So we really want to understand, what are your dreams? What are your aspirations? What are your goals? And then we set timelines to them. And then we put together a plan that you can work towards, and that can be your guide throughout. So go and speak to a financial planner.
Let's talk a little bit about some of the financial vehicles. And I know I touched on it very briefly because I was waiting for this discussion with you now. And so for people who are new to investing, how do options such as unit trust funds and exchange traded funds help? And maybe you can start by, because I see quite a few people have mentioned that they arrived late. So maybe you can touch on maybe explaining to us, what are unit trusts, what are ETFs, and how do they help? Okay.
So basically a unit trust, you used the word earlier, it's a collective investment scheme, right? That's the more fancier words to describe them, but more commonly known as unit trusts. Essentially, it's a vehicle that all of us can pitch into, right? Put our monies into. There's a fund manager that makes investment calls on our behalf. What does that mean? It means they are deciding on our behalf which shares they are going to buy. They are deciding how much money they are going to allocate or invest in South African companies, how much money they are going to allocate and invest to offshore companies, so offshore equity, right? So a unit trust can very easily, accessibly, and cheaply afford one the opportunity to be able to access all of these different kinds of investments. You spoke about exchange traded funds. So an exchange traded fund is very similar to a unit trust. The difference being that an exchange traded fund references a particular segment of the market. So if you look at the Johannesburg Stock Exchange, for example, there's the financial sector, there's the resources sector, there's the property sector, you know, there are commodities and so forth. So an exchange traded fund will follow a certain basket in the market. So unlike a collective investment scheme or a unit trust, you'll often hear the term to say an exchange traded fund is passively managed. So in other words, there isn't a team there or a fund manager that's making a call to say, right, today I'm buying MTN shares or I'm selling Vodacom. It's following the entire sector. Okay. Mm-hmm. Whereas in a unit trust, you've got a team of portfolio managers, analysts who produce research, who make projections, who then make the decision to say, right, we think that MTN is a better telecoms company than a Vodacom, for example. You and I, or just a person off the street, doesn't necessarily have the skill set to be able to do that. So a unit trust gives you an opportunity to invest in, you know, what a portfolio manager may deem to be the best in the market, or is able to meet a certain objective. When you look at unit trusts, first of all, they'll be risk profiled. So again, depending on the amount of risk you as an investor are willing and able to assume. Okay, so what do I mean by that? A unit trust, for example, can be classified as a low risk unit trust. And typically that kind of unit trust would be investing in cash, would be investing in near-term bonds or longer-term bonds. So essentially, what you would find there is that the money that you invest is quite stable, right? So as you receive your statements, you'll see that the 100 Rand that I invested, okay, is growing steadily over time and it never goes down very much, okay? So that we call a stable, low-risk investment. You also find, for example, a medium risk portfolio. Now there, the portfolio managers would be combining different asset classes. So there would be some shares, both local and offshore. There'd be some property stocks in there. There'd be some bonds and so forth. So they would diversify. You spoke about diversifying, Darren. So in other words, they would split this basket, right? Mm-hmm. And the reason that they do that is because, number one, they are trying to reach a certain growth target. But depending on the mandate of the fund or the risk profile of the fund, they also need to make sure that the fund behaves a certain way or your capital behaves a certain way. In other words, in a medium fund, as much as you want your investments to grow, you don't necessarily want it to fluctuate too much in value. So they need to be cognizant of those requirements. The extreme end of the portfolio would be terms that you'd come across, for example, are high risk or an aggressive portfolio. What that essentially means is that kind of unit trust would typically have quite a high weighting to equity, either South African or offshore equity or a combination of both, right? Why is it high risk? It's because of the volatility. So in other words, your 100 Rand has the potential of the value of your 100 Rand has the potential of fluctuating, going up and down in the short period, okay? But when we talk about equity investments, we always say one needs to have time on your side. So we said earlier, this is money that you need to be prepared to invest for the long term. Why is that important? Because investments like equity in the short term can be quite volatile. They'll move up and down quite rapidly. But that up and down movement tends to smooth itself out over time. Okay, so that's why you need the time. What does that mean for you? It means, well, you started off with 100 Rand. It's going to go up and down, go up and down. It may be your 100 Rand, maybe 95 Rand one day. The next time you receive a statement or you check into your investments, it may be sitting at 110 Rand. Then if you check in 2 years later, it's sitting at 125 or 130 Rands. Then COVID happens, then it's back down again at 95 Rand. That's volatility. I can see your expression. That's what we mean when we say volatility. So that's why you need to give it some time, because, you know, as much as a COVID event can happen, yes, they do happen, but like we've seen, the markets in this instance recovered quite rapidly. So you need to give that segment of your portfolio some time so that it can work out all of this up and down movement that I've been talking about.
Right. I can see quite a few questions coming through in the chat, and we will get to all of your questions. I think we're doing very good for time, so hopefully Palesa will be able to answer all of the questions. So I do see your questions, Angela, Ngumisa, Tabi, so I see your questions. You can continue, Palesa. Were you about to say something else?
Okay, so we've spoken about unit trusts and ETFs. I think the other important point to make, I like to explain it as a shell or a vehicle, right? And when we talk about shells or vehicles, that's where your unit trusts and your ETFs go into, right? So a retirement annuity, for example, or a tax-free investment, or an endowment, or a share portfolio are vehicles through which you can own your investments, right? And there are various reasons why one would use a share portfolio, for example, as opposed to a retirement annuity. It all talks to what it is that what you're trying to achieve and what that pot of money is for, right? So I spoke about the vehicle or the shell that your investment goes into. And then the unit trusts that we're talking about is what you're going to be putting into your retirement annuity. Okay, and that's where the growth of your investment actually comes in. And I'm trying to explain this because often somebody will come to us and they'll say, well, you know, I started a retirement annuity 20 years ago and my money hasn't grown. Retirement annuities don't work. And then when we look at a statement and see what's actually happened, yes, they're invested in a retirement annuity, but the retirement annuity is invested in a money market fund. Okay. Money market fund, what did we say earlier? Money market or cash investments don't give you much growth. So the problem is not the retirement annuity, but how your retirement annuity is invested. So if you are investing for the long term and you're looking for your money to grow, then you need to be investing in a portfolio that has some equity exposure, because that's actually what gives growth over time. So some equity exposure, some bond exposure, equity exposure, property exposure, and so forth.
This can be such an in-depth conversation. I think we're learning so much. So I know that a lot of people, obviously, or people who are employed, right, are assisted by their employer to save for the future and to get some insurance for unexpected events, for example, retirement savings or medical aid or life or funeral cover. So with people who are self-employed or entrepreneurs or freelancers, how can they best work around such kind of savings as well?
I'd like to answer that one more broadly, Darren, and I'm going to take it back a little bit, okay? So, I mean, you spoke about medical aid, you know, retirement, savings, and so forth. Now, as an artist or a freelancer, I think it's important for you to think of yourself as a business, because you are a business. Okay. If you're an artist, you are earning your income because you are able to show up on set and do something magical in front of the camera. Okay. That's your asset. If you are now, the people in the room will excuse me, I'm the finance person and not necessarily film and creative. But I mean, if you produce a work of art, I don't know, a movie and things like that, you know, that's the asset that you are that you are producing. So you need to think about what is the best structure to protect all of this intellectual property that you are producing. Okay. Why I'm saying this is because when you start talking about life cover, for example, you are in essence talking about, it's an estate planning discussion. When we talk about estate planning, it's about what will happen after I pass, okay? How will my children be taken care of? What will happen to my assets? What will happen to the property that I own? What will happen to my, I don't know, master rights? What will happen to my publishing rights? All of those things. So right from the onset, you need to be very clear about how it is that you're going to operate, and how best can your intellectual property be protected. And I'd encourage you to bring the right skill sets into the room. You know, a certified financial planner can certainly help you, but when you start talking about structuring, you really want legal minds to be able to advise on the right structure. So a financial planner can help facilitate those kinds of conversations and bring the right skill set into the room for you. So I highlight rights specifically because those can be assets over time that are going to outlive you. So the question then is, how are you going to protect those so that your children or the people that you wish to benefit from your work actually do so? And there are various structures that we can put in place to be able to help you achieve that. Once that is in place, then I think we can start talking about, okay, how much life cover do I need? Because life cover is actually a plug-in, right? Life cover comes in when we've identified a shortfall and there's no income producing asset that can plug in that requirement. What do I mean? You pass away today, you've got young children who still need to go to school. There are no assets that will produce royalties and things like that that will pay for these children, for your children's education. Then we bring in life cover to say, okay, in that event, because the assets, don't cover the required expenses, let's bring in life cover. Then the question would be, well, how much life cover do you need? So what I'm trying to explain here is that it's not a thumb suck. Please don't go into a financial planner's office or somebody at the bank and they say, right, oh, you look like somebody who lives quite a high life. Let's give you 10 million Rand worth of life cover. No, it needs to be based on something, right? It needs to be based on your aspirations. It needs to be based on the people that you need to take care of. It needs to take into account the assets that you already have in place. And then it acts as a stopgap, for example, if I can call it that, to close a gap that isn't otherwise catered for through other means. So when we talk about life cover, it's an estate planning conversation, and that's how we think about it, right? It needs to take your assets into consideration, and then we plug in the life cover and things like that. Life or policies or insurance can also act as a risk mitigation strategy. So, for example, I think about a Tina Turner, if the internet is anything to be believed. Apparently, she insured her legs, for example. Mariah Carey apparently insured her voice. So as an artist, you also need to think that way. Which of your faculties is your income producer and what do you need to protect? Now, I don't think in South Africa, our industry is that sophisticated that you can just insure your legs. but there is occupational disability. So in other words, if you are no longer able to act, if you are no longer able to read a script, you know, that can be an event that can be classified as a disability. You can have income protection, where then your income is either paid out if it was, you know, a consistent one or one that you can prove, or a lump sum disability can be paid out to you. So insurance can also act as a means for you to mitigate some risks that you face. You also spoke about retirement and investments, Darren, and quite correctly, in a 9-to-5 job, all of these benefits most probably are available to you as part of some kind of employee benefit scheme, right? But even as a freelancer, even as an individual, you know, you can have all of these things put in place for you in your individual capacity. Earlier, I said that organize yourself well. You know, if you are an artist and you've got a full-time executive PA, I don't know, an agent or whoever, people around you that help you carry out your job. You think of yourself as a company and those individuals are employed in the company, you can actually start an employee benefit scheme for that group of people. Usually, the companies will either work on a minimum contribution, so they want to make sure that there's X amount, and it's not a lot. I mean, from 5,000 Rand, for example, you can put together a scheme for the people that you employ. You can put together a group life scheme or group risk scheme. You can put together a retirement fund for your people as well. Failing that, you can do it in your personal capacity, have all of these things put in place for yourself. And you start, I think, by engaging with a financial planner, with a certified financial planner, to help you first quantify how much of these things do you need? How much life cover do you need? What kind of disability protection do you need? Do you need dread disease cover? So all of those things a financial planner can help you with. With retirements, I think, you know, the inconsistency of income is sometimes an issue. And it's an issue where you have started a retirement annuity, for example, that is insurance linked, okay? Because right at the onset of that kind of retirement annuity, it's called an underwriting process. So in other words, they want to find out, all right, how old is Darren? And when does he want to retire? Darren is 30 years old. He wants to retire at the age of 65. And we expect that he's going to be contributing to this retirement annuity. He's going to be contributing 1,000 Rand a month, okay? Then Darren's gig on Isidingo or Gomora falls away. And now you can't make those contributions anymore, because in an insurance-linked retirement annuity, you got into that agreement and it was expected that it'll go a certain way over a certain period. If you break those agreements, that's when people then become unhappy, because you'll find the insurance companies now levying a penalty because now you're stopping the contributions. There are other alternatives, and that is called, for example, an insurance-linked retirement annuity. It's sometimes referred to as a new generation retirement annuity. What that offers you is the opportunity to contribute to it as and when you can, as and when you want to. So for example, you can make a once-off contribution a year when you've just come off a good gig that's paid you well. Or you can start and stop a regular contribution into the retirement annuity as and when it suits your circumstances without having to be penalized. So you'd be looking for a new generation retirement annuity or an investment-linked retirement annuity. So whenever you see a retirement annuity and they say, right, here's a death cover, here's a whatever, then you know it's insurance linked. And because you earn an inconsistent income, it might not be 100% suitable for you. You spoke about tax-free investments earlier, Darren, and I'd like to touch on those a little bit. I think tax-free investments are really a very, very powerful instrument if used well. Vehicle, if used well. So if I can just explain a tax-free investment quickly. They were started, the government introduced them about 3 or 4 years ago, essentially to encourage all of us to start saving and investing, right? And how do they encourage us? They say, okay, any amount that you put into this kind of vehicle won't be taxed while it's while it's being invested, and it won't be taxed when you pull it out either. So when you withdraw from it either. So essentially, it's an opportunity for you to build up a nest egg that won't be taxed now and won't be taxed in the future. I think the right place for a tax-free investment is for a long-term investment. I know sometimes even at the banks, you know, it is an alternative if you're looking for a savings account or a savings vehicle for short-term money. You can certainly use it for that, but I think it's a much more powerful vehicle when it's used for a long-term investment, because you are building a pot that can never, that won't be taxed. At the moment, the maximum that you can invest into a tax-free investment on an annual basis is 36,000 Rand. I know it's not a lot of money, but with compounding, it can still be quite a useful product to use. There's a lifetime limit of 500,000 Rand at the moment. And at every budget speech, we hope that the minister will, you know, increase those limits a bit. You need to be very careful that you don't invest more than 36,000 or whatever the limit may be in a particular year, because if you go over the limit, you are actually penalized and taxed on that amount at over 40%. So used correctly, it can also be quite a powerful instrument that can help you save towards your retirement or your long-term investments without your long-term goals without being taxed.
Let's talk about retirement, because we always hear start early, start early, start early. Why is it important to start saving for retirement from an early age?
So when we plan for our clients, we use what is called a replacement ratio. So the big brains and what have you have done the calculations, and we say, well, you know, a comfortable retirement is where you are able to replace at least 75% of your income. What does that mean? It means that if I was earning R1 million every year, when I'm retired, a comfortable retirement would be if I can at least replace 75% of that. So in other words, if I can afford to live off 750,000 per year when I'm retired. It may sound like a lot, but it's actually possible. It's possible when you start early. Now, when you are starting off, you know, working in your 20s or not of you, I heard you call out a percentage earlier, Darren. But I would say, you know, in your 20s, ideally be saving at least 22% or so. Then you'll be, and then of course, over time, as your circumstances change, that percentage also needs to be increasing. If you start early and start at a good percentage like that, then you are well on your way to achieving that replacement ratio of 75%. If you start later, actually, Darren, I'm going to give you a little bit of a shock. I think you said 20% earlier. If you only start saving towards your retirement at the age of 45, and you want to achieve a 75% replacement ratio, you need to be putting aside 59%, almost 60% of your income. Now you tell me, who in the room can comfortably put away 60% of their income every year or every month? It's not easy, right? Some people can do it, but it's not easy. So if you want your investment And I know I use the term savings and investments interchangeably, but just understand that we're talking about long-term money here. So if you are looking to invest for the long term and build a nice, sizable nest egg for yourself for your retirement or whatever goal that you may have in the future, you do need to start early so that you can benefit from compounding, but also that time can be on your side.
Talking about compounding, let's talk about how can I earn the full benefits of compounding growth when investing, and then maybe also touch on inflation. So how do we beat inflation when it comes to our investments?
Okay, so when we were talking about unit trusts earlier, I spoke about how they can be risk profiled, right? So it can be a low risk, medium risk, high risk unit trust. The other thing to look out for on a unit trust, it'll have a target. So in other words, the portfolio manager is not just working in a view and choosing, randomly how much they are going to be investing in equity and so forth. They are trying to achieve something. They are trying to achieve a specific target. And that target is usually expressed as inflation plus something. So you'll see CPI plus 5% or CPI plus 6%. So essentially what that is telling you is that the portfolio manager, number one, needs to beat inflation. And then over and above inflation, they need to return a certain amount net of their costs. All right. Why is it important to beat inflation, and what is inflation? Inflation is essentially, if I go to Pick n Pay today and I have 100 Rand in my pocket, I'll be able to buy bread, a loaf of bread. I'll be able to buy 2 liters of milk. I'll be able to buy a small container of peanut butter. That's what 100 Rand can buy me today. In 5 years' time, that same 100 Rand won't be able to buy me the same goods, right? I'll probably be able to buy a loaf of bread and the milk if I'm lucky. So that's inflation. Inflation is what eats away at the purchasing power of your money. So when we say an investment portfolio needs to keep up with inflation, essentially it needs to make sure that you are able, your 100 Rand is able to buy the same basket of goods it can today in 15 years' time. Now, in 15 years' time, your 100 Rand won't be 100 Rand. It'll probably be 1,200 Rand, but its actual purchasing power is still the bread, the milk carton, and the peanut butter. So that's what we mean by inflation. So whenever you are looking at the performance or the return on your portfolio, the first hurdle or the first thing that you want to make sure that it's doing is that it's beating inflation. It's making sure that the purchasing power of your money is protected over time. But protecting the purchasing power of your money is not necessarily creating wealth for you, is not necessarily making you money. So that's where the other component of that formula, that CPI plus that I'm talking about, right? So that's how your portfolio needs to be delivering. Then you know, right, I'll be able to buy the same basket of goods when I'm 60 years old, and I would have created a little bit of wealth for myself as well in the future. So you asked about the benefit of compounding and investing early. Essentially, you alluded to it earlier. Darren, you spoke about capital gains, you spoke about dividends, you spoke about interest. So when you are investing, those are the different components. That's where the growth in your investment comes from, right? Shares on the JSE or companies that are listed on the JSE, even internationally, as they are making profits, they share those profits with the shareholders, right? The shareholders are the people that actually own those shares. Those the shares, your piece of the profits is called a dividend. So they pay out in dividends. So that's the first part that'll make your money grow over time. The second one is the actual appreciation of the share itself, if I can use that as an example. So let's say today you are buying I'll use MTN again as an example. You are buying MTN shares and they cost you 300 Rand today. If it's a good investment, in 10 years' time, what you bought for 300 Rand today must be worth, I don't know, 450, 600 Rand. Then you know it's been a good investment because there's been a capital gain, there's been growth on your investment. The last component that gives growth in a portfolio is interest. So cash investments, investing in bonds, for example, all of those yield interest. Okay, and that's also another component that can add towards growing your money over time. So as all of these components add to your portfolio, because you are not withdrawing from it, you are letting the growth grow upon growth, the interest on interest, the interest grow upon interest. So all of that is what we refer to as compounding. And for compounding to take actual effect and for you to really benefit from it, you need to be invested for the long term. So I go back to what we discussed earlier to say, you need to be clear what is savings, what is investments, because the last thing you want to do is now call or withdraw from your share portfolio because there's you need to replace tires. You could be withdrawing in a time that's really not great, that's really not opportune, and then you withdraw at a loss, for example. So when we talk about investing, that's why you need to have time on your side and be clear about what that pot of money is for.
Okay. So then, obviously, it seems like the best way is to then join this WhatsApp stock file that I've got on my. I'm joking. So let's talk about scams. How do we identify scams when investing, and how do I protect myself against scams? We know that obviously this whole investing world can seem so overwhelming if we don't have a discussion with a financial planner, and so many times people fall prey to and fall victim to these scams. How do we identify scams? How do we protect ourselves against scams?
So whenever somebody comes to you and they are offering financial advice, or there's some kind of investment scheme, okay? So any company needs to be registered with the FSCA, the Financial Sector Conduct Authority. It used to be called the Financial Services Board. It became the FSCA a couple of years ago. Now, the FSCA has a search function on their website. You can go onto there. In fact, you can Google FSP search. It'll take you directly to that page on their website. There you can check, for example, the name of the company. Okay, so all financial services providers, companies need to be registered with the FSCA. That's the first one. The second one is whoever you are engaging with. So Palesa Dube, who's from Wealth Creed, you need to make sure, all right, is Wealth Creed registered with the FSCA, number one. And number two, is Palesa Dube an authorized representative of Wealth Creed? And all of that information is publicly available there. Yeah, that's a good way to start, because that is the authority's way of making sure that the people you are engaging with, number one, the business itself is operationally sound, right? So in order to register at FSP, there's a whole lot of criteria that a company needs to meet before you can sit in front of clients. Even as an individual, there are certain requirements that you are required to meet, from qualifications to experience and all of that, before you can be a representative and be authorized to give advice. So go to the FSCA website and search for that. It also gives you more information. So for example, if you search my name, you'll be able to see what instruments or what types of investments I am authorized to give advice in. So if I'm going to be advising you on life cover, you need to be sure that I'm authorized to do so, and you can do so. You can check that on the website. If a person is going to be advising you on shares, you can check there. Are they authorized? Are they properly qualified to give me advice on shares. So that's a good resource to check with. There's a lot these days around, stock, trading currencies and with all those kinds of things. The JSE is also another way to check. You can check if a brokerage is registered with the Johannesburg Stock Exchange. Again, there are onerous criteria that a provider would need to meet before they can be properly authorized. And all of those measures are to protect the public. So do yourself a favor and check on those sites.
I think you actually answered Sandilia's question, because Sandilia's question was, where do we check if the investment company investing with is registered? So great stuff. Palesa, I think you've been brilliant. I think you've broken down so many concepts that seemed so big and so foreign to us. You've really been able to break it down. And so thank you so much for that. Don't go too far, because I see there are quite a few questions. The team has collated the questions as well, and so I'm going to get to them shortly. So, and then start thinking about your tip for the week as well. But for now, thank you so much for sharing so openly with us. It was really, really informative.
It's a pleasure.
All right, that's Palesa Dube, our certified financial planner for today. Let's get into some questions. Palesa, Mam Sibongile, if you could put your cameras on, and then we'll see how we can get through some of these questions. Palesa, I think the first one that was quite an interesting question is, how do we find an effective financial manager or a CFP who will have our best interest at heart, and also somebody who understands freelancer issues?
I think finding a financial advisor is much like finding a GP. So how do you find a doctor? So they are qualified, but maybe there's just, you like this one because when you go there, you can all talk about soccer, right? Or you are all golfers. So yes, qualifications are important. And our industry is also, it's improving, it's becoming more regulated. When you deal with a chartered accountant or with an accountant, you want to see a CASA, right? Then you know, okay, that's a mark of quality. They belong to a professional body. They subscribe to a certain ethical code and all of that. Our industry has also moved that way. And our industry qualification is a CFP, so a Certified Financial Planner. And our industry body is the Financial Planning Institute of South Africa. So that's a good way to start. Not all financial advisors or brokers that you will see are CFPs, but I think you can take comfort from dealing with a CFP. So that's the basic qualification, proper authorization and all of that. The next level will be a subjective one. Who do you resonate with and who understands you? Because that it's quite nuanced, because you may say, as a female, for example, I want to deal with a female because they understand where I come from. As a young person, I want to deal with a young person because they understand where I am in my life. So the second layer is a subjective one, and it'll be somebody that talks to you and really hears what you are trying to do. I'll stop there.
The other question, this one was from Tabiso, and he asked, is it advisable to open a separate account and put the card away, far away, for emergency savings?
So Tabiso, your credit card is not an emergency saving. I think we have been so spoiled in South Africa. When you live in an economy in a country like ours that is so well developed and these things are just readily available. If you go to the rest of Africa, for example, it's not uncommon to buy a house cash, to buy a car cash. We've moved so much away from that we think it's okay to even buy clothes with a credit card or buy clothes on hire purchase. I think we need to challenge our thinking. Why is it that you are buying clothes on hire purchase? Why not save up, wait for a sale, and then go and buy what you need? So perhaps it's a question around your budgeting. Maybe you need to be side hustling, getting a little bit more income and things like that. But your credit card is certainly not to be used as an emergency fund. An emergency fund is money that you have actually saved up so that you don't go borrowing. Because your credit card, have a look at your statement. The interest rate on that is quite high. I wouldn't be surprised if it's around 13, 15, 16%. Some cards out there, you're paying 20%, and you're wondering why it is that you can never pay this thing off. It's because the interest rate on it is so high. So your card is not an emergency. So yes, put it away very far.
Would that process, so let's say Thabiso was maybe referring to a savings account. So would it be advisable to open a savings account and put the bank card away so that you don't use it only when there's emergencies? Would that be a better option?
Yeah, so also check sometimes your credit card, where you have debit balances, for example, you could earn some interest. It's usually not that high, but just check. If your credit card can give you a higher interest rate than you can get in a call account and things like that, not usually the case, but compare the interest that you can get in the various facilities.
All right, another one was, how do money markets work as an emerging creative? How can that be beneficial to me?
Okay, so we've been talking about your emergency fund. And we said that the ideal place to put an emergency fund, because you also don't want to put the money in a suitcase and somewhere in your wardrobe, right? Because then it's doing nothing for you. You want it to be earning some interest and growing. But like Darren said at the beginning, the money in a call account, for example, won't necessarily, if it keeps up with inflation, it's doing well. It won't beat inflation by a whole lot. So that's why it's important. That's why you limit your emergency fund, because that's what it's for. The reason you put it in a money market fund is because a money market fund is stable. Unlike a share whose value goes up and down, your 100 Rand in a money market fund will stay 100 Rand and just earn interest over time. So that's how you can use that.
As someone starting out, how does one monitor the growth in a unit trust?
So technology has advanced quite a lot lately. With almost all of the providers, you can access your information online. And then some providers go as far as giving you an app where you can follow, your investments and balances on your phone. So the information is quite readily available. Over and above that, we are obliged by law to send, clients their investment statements at least once a year. And providers usually send statements much more often than that, sometimes quarterly, sometimes monthly. So you can choose how often you want them and what mode you want to be receiving them. So you probably want to choose email so that it finds you, your statement finds you wherever you are.
And how often should you be checking? Because I'm thinking some people might check and they see, oh, it's gone down, let me take it out. Oh, it's gone up, let me take it out. But I think established investing is supposed to be medium to long term.
Yeah. Look, I think know thyself. That's what I'm gonna say. If you know that when you see that your investment is down a certain percentage and it makes you nervous, then when you get that statement, don't open it. Open it on Christmas Day when you are on holiday somewhere. If you know that it's going to make you nervous and you might want to, withdraw your funds and things like that, then don't look at it regularly. If you understand that your investments go up and down and you are prepared and you can, leave the investment there, then by all means, check as often as you want to. But just be clear, what is my savings and what are my investments? My investments are there for the long term. They are going to go up and down. Give them some time.
Nice one. And then the last one is room rentals or property a good long-term investment?
So you spoke about that a bit. So the REITs. So the difference between that and a property that you own in your personal capacity. is that a listed, the REITs, for example, are investing in corporate and industrial property, so your shopping centers, your office buildings, your manufacturing plants and all of that. So the portfolio that you are investing in through a REIT or a property unit trust is much wider than you do when you are investing in your own property. We spoke about diversification. So a fund will give you better opportunity for diversification rather than investing in your own property. I understand that people are, we are visual beings, right? You like seeing something tangible and visiting it and making sure that your tenant is taking care of your property. But it also comes with all of those nigglies that you'd need to concern yourself about. Whereas in a unit trust, for example, you are not worried whether Fourways Mall is being swept and mopped, or you are not worried if the windows are being washed. You're not worried if the plumbing is being maintained. Whereas if it's your property, then all of those things become an issue. Over and above that, if you find yourself with a tenant, for example, that defaults and is no longer paying you, and you have financed that property, then you run the risk of now having to fund that property yourself or pay for that property yourself. So one needs to think about all of these things. It's not to say that residential property or private property that you own yourself is a bad investment alternative. Just think about the options. What works better for you. Think about the risk you are assuming. Where's the property? What is the probability of the property appreciating in value? What is the likelihood of you always having a tenant? All of those things. You need to weigh the two to decide which is best for you.
Another question here. Which retirement age can you recommend for an artist? Is that something that you can recommend, or is it a personal decision? Mamsibongile, I think maybe, especially because you're in the industry, what is the trend? What do you think? How at what age do most artists retire?
Artists never retire. We don't retire. We don't retire. As long as you are still able to do what you are doing and you are good at it, keep doing it. A friend of mine went to some book fair somewhere, and then she was telling me that there's this writer, she's 80 years old. She has written 2 books, and she's like, I'm still going to write another one. She's 80. Sure. 80 years.
Well, I think it also speaks to what you touched on right at the beginning, Palesa, where you said you need to almost think about your legacy and think about what is it that's going to be creating recurring income even after you stop working, and then plug in life cover into that. I think that was such a great concept and how you explained that. Yeah,
exactly. I think also the face of retirement is changing. When I was young and your parents or your aunts, my school principals, when they were going on retirement, they were really old crocs, You could see that it was time for them to retire. We are living longer. We are a lot more vital. And so people are, instead of retiring, people are just morphing into a different kind of work, like Sibongile is doing. She's teaching the young ones at the moment. That's something that you can do until, forever. In the corporate space, we are seeing people, they go on boards, and the world has evolved. You can put up a webinar or a program and be paid for it because people are prepared to pay for such content. So retirement is changing. Perhaps you will retire from your 9-to-5 or what you are doing, or from the front of the camera, and you'll find something in the background. So it's a personal decision.
Beautiful. And on that note, I want to read one or two comments and then we're going to close it off. I think the first one is from David. David saying, this presentation is so useful for the industry. I feel that the sector must benefit out of these sessions. We have a group WhatsApps that are represented by the cultural industry. In future, let us send this invite to all of them as well. Absolutely, David, you are most welcome to share this information. Share the link, share the invite, and let's get more people let's get more people this knowledge. Let's share what we're getting. I think it's so important. And then a comment from Angela saying, listening to Palesa speak has made me feel much clearer and braver about dealing with financial products. So thank you so much for that, Palesa. I think you've shared so openly. Let's get your final closing comments from both of our guests and your tip for the week. I think we'll start off with you, Mam Sibongile, all the way from number 24. There where you are.
Oh. Okay, I am not a financial expert, but I think I've learned a lot of things along my journey. And even being here on this webinar, I'm confident and I'm even dreaming to even achieve more. But what I can say is, whether there are resources right now for you or you don't have them, it's important to set that plan. Start thinking about it. You'll be surprised how the universe will even bring them forth to you. The most important thing is to start. When you have that plan, it's good. You are going to keep on meditating about it. Even if there are no resources, something will happen for you. The other thing is, I'm not a financial expert, so I'm also learning myself. I've made so many mistakes. Some of my policies have lapsed, but right now, I made that decision that the ones that I have now, I'm going to make sure that they don't. So I take that decision, and the time to decide is now. We can no longer keep on postponing it. The other thing is, in all of us, we are excelling in whatever we do. So there's a blueprint that I have mastered as a performer. There's a blueprint that somebody on this platform has mastered. Why can't we take those blueprints and actually apply them to our finances? Because it's something that you have tried and tested. As much as obviously each character come with something different for you as a performer, it's a learning process which is ongoing. But there are things that I've mastered as a performer, and there's no competition when it comes to performance. When I do my role, I know that I do to the best of my ability. So there's something there that I've mastered and that I'm doing right. So the same strategy that I'm using for my performance, I can actually take it and apply to my finances or in any other area of my life. Listen to your inner voice. Beautiful. Listen to your inner voice. The inner voice is never wrong. If it feels good, go for it.
Beautiful. Mam Sibongile, thank you so much. And I think you've been so inspiring. And I think you've given so much hope just to artists to realize that start, and I think the point that you're making right now is, once you get to the point where you are learning and where you are seeing results, share that results with your community, share that results with people in your sphere of influence. Thank you for being on the webinar today, and thank you for sharing so openly.
Thank you.
We'll see you on TV. Palesa, your final words?
I loved that as well, Mam Sibongile. Thank you very much. Your story is really, really inspiring. I truly believe that, like you read in my bio, Darren, I really, really believe that wealth is amongst all of our reach. Wealth does not have to be the preserve of a few. And I think as artists, particularly in South Africa, with the kind of background that we come from with, exploitation, Mam Sibongile spoke about it earlier, that our artists die young, as has been said in the comments, they die young, but the stories that we get when they pass on are really not great. So I would like to challenge you, like I said earlier, think of yourself as a business. Formalize your trade, because that's what you are. You are the business. And once you do that, you start having relevant conversations around how do you protect your work, and how do you protect it so that it benefits it benefits your family and those that come after you, people that you really care about. So I'm going to challenge the people in the room to say, how can I formalize and take myself a little bit more seriously, and guard this IP that I bring out every day? And then come and engage with a financial planner. Find a certified financial planner in your area and have the conversation to start putting all of these arrangements in place for you.
Halesa, thank you. You've done an amazing job. I think we could hang on your words all day because you've really done such a great job and you were so thorough. Thank you so much for being on the webinar today.
Absolute pleasure.
That's it, guys. So as we get to the end, let me quickly announce two winners just for your participation in today's webinar. And so first up, we have Numisa. So let's give some snaps and claps and congrats in the chat for Numisa. You get a 300 Rand shopping voucher. And so that means we are freeing up 300 Rand of your budget somehow for you to now redirect somewhere, right? So you can now buy shares for 300 Rand. And then last but not least, our second winner for today, a 300 Rand voucher, is Angela. Angela, so well done to you. 300 Rand voucher coming your way as well. So you can buy a property, but now with the 300 Rand that you're saving, buy a property and you can become a landlord. Okay, well, awesome stuff, guys. Thank you so much. Again, just before we go, a reminder that the webinar, the replay is available on the website. So please go to the website, www.buildup.org.za. The private Facebook group is Build Up for Artists. That's on Facebook. Private group, join the group, interact there. And then as David recommended, let's invite more people to these sessions, guys. This is so empowering. This is a wealth of information that you would pay top dollar for. And so the fact that it's here for free, please, let's encourage more people to join. I will see you on Thursday. On Thursday, we have our masterclass, Building Your Brand, Building Your Brand masterclass happening on Thursday. Remember, we start at 10 a.m., no longer 12 a.m. So please be on time, be here at 10 a.m., same time, same place. My name is Darren August. It's been an absolute pleasure being your host on today's webinar. I'll see you on Thursday for the masterclass of the Build Up Financial Literacy Program for Artists, brought to you by the ASISA Foundation. Thank you for your time. Thank you for joining us. We have finished right on time with 2 minutes to spare, and I hope that you have a great day further. I will see you on Thursday. Bye-bye, everybody.